Our loan growth has in good times been of the order of about 40%. If because we are just coming out of COVID, because there was so much captive demand and we were all conservative in that phase. What we have seen a typical phase after the crisis is that there is good credit to be done, good growth to be done, and therefore we should be broadly in the range of 40 to 50% in the phase, especially coming out of crisis. And if you are a good performing institution, to deliver a 40% growth rate, typically, in a consistent basis is also not surprising, other than in the middle of a crisis. Fundamentally, we are very tightly leveraged at this point of time. As you know, in banks, even if you make good profits, unless you do a full audit, which you don't normally do, we cannot take the profits into the balance sheet. So we actually get stuck on a capital that we have on a March 31st number, and the whole year's capital will not get added to your profits, will not get added to your capital. So, these are very strange circumstances that we do it for a IPO reason or for a merger reason, that do a full audit. Otherwise, this bank couldn't have used the 400, 450, 500 crore kind of profit it will have for the full year. So, and then we are growing reasonably fast. And the other thing is that when times are good, you get capital and you should take capital, not over leverage. We have been a CAR of 20 to 25% all through. I also believe that CAR should not go below 20. So I think in good times, we have to raise capital. Capital is the foundation of a good financial services business.